Now, to help us make sense of all of this, markets in negative territory, currencies seeing continued volatility. How as an investor are you meant to make your decisions based on the current market performance? Well, Peter Brooke, he is the boutique head at Old Mutual Investment Group MacroSolutions, joins us now from our studio in Cape Town to give us more perspective as to what's unfolding on the current market environment. Peter, so good to have you with us as always. Looking at the South African Aussie performance today, you swear that we've never touched 55,000, but your view on the current volatile environment on the markets. Is South Africa the only victim to the significant sell-off?
Well, Gugu, markets are really worried about three things: US interest rates, Greece, and Chinese growth. And today we actually had a number of those coming through with some bad news. Particularly China came out with their CPI numbers, which were 1.2%, a bit lower than expectations, and a lack of inflation just shows that there's very little growth coming through in that side. And if we look at their PPI, or their producer price inflation, that was minus 4.6, so very weak there. So I think that didn't help our market, and particularly then we had the Greeks. They put forward another proposal to the Europeans in terms of looking for a bailout plan. Doesn't look very credible, so that creates further uncertainty. And then US markets were weak last night, which flowed through into our market. So we had a bit of a triple whammy with all three different factors exacerbating our market and causing the fall today.
Peter, what does this do for the valuations of our market? We know that the Aussie itself is also obviously quite overstretched. Does this mean that there could be some short-term relief when it comes to how expensive our local market is?
Well, month to date we're about 2% down. Last month we were 5% down, so the correction's around 7%. But you've got to remember we'd had a very strong 4 months at the beginning of the year, and April was particularly strong. I think a lot of this decline is actually justified. Markets had got expensive. I know in terms of our funds on behalf of our clients, we had sold equity in the first period of the year. So I think much of what we're seeing was required. As to whether it's offering great value, I think it's going to be a bit more specific. You're going to have to look for 1 or 2 shares as opposed to the entire market's offering value.
Let's talk about particular stocks that offer value. We look at the performance of Anglo Gold Ashanti today, obviously related to the news regarding the sale of its US assets there. But your view of that particular sector being resources overall, is it still maybe considered the dog of the market that isn't getting too much attention at the moment?
Well, let's just chat a little bit about that Anglo Gold story. I mean, I think the market reaction was very clear, very positive, and it is a good deal. So cutting the debt is very positive, but also what Venkat didn't mention is they've sold their only asset in America. So it simplifies their structure, it enables them to manage the business more simply. It is good news. If we look at gold, the gold sector was up hugely today, up 6.6%, driven by Anglo Gold, but all the shares did well. But if we look month to date, the sector's still down 2%, which just shows you how very volatile that gold sector is. It's not an area that we've tended to invest heavily, and that predominantly because of that volatility. The uncertainty of cash flows means that it isn't great as a long-term investment. I think if we look at the broader resources, however, it's underperformed very, very strongly. That has attracted a number of people back into it, looking for value. We don't see a lot of value at the moment, and the reason for that is the underlying earnings have been very heavily damaged by the fall in commodity prices. And we think those commodity prices deserve to fall. They were high in real terms, and we've seen a very strong supply response across the world, but particularly in iron ore, where we've had new supply coming in. And I think we're going to trap those commodity prices at lower levels, meaning that the free cash generation from those companies isn't going to come through. We find more value in the financial sector of the market.
Peter, looking at the overall concerns, we know that the currency has also been a particular index that's extremely volatile at the moment. You mentioned financials, which might prove to be slightly more appealing, but from your end, where else should investors be looking for opportunities of value?
Look, our fundamental work shows that returns going forward are going to be lower than they have been in the past. And that's because PE multiples are higher, the property sector is re-rated, you look globally, very low bond yields, negative yields in cash in some places. It's going to be tough to find returns. And I think you're going to have to be a lot more selective. Interestingly, an area that we think is starting to look quite interesting is the South African bond market. You know, at the long end of the curve, you're getting bonds yielding 9%. If inflation is around 6%, that's a 3% real return. And that's what we're looking for, is to deliver real returns to our customers. And in an environment where we're finding that hard to find those real returns, 3% is pretty good.
Well, we certainly hope so. Peter, thank you so much for your time today and analysis of the local market space.